I'd like to introduce Patrick Salami, Natalie's husband. He'll be presenting Spritzle.io, which he developed with her in cohort 1.
Cool. Thanks, Robert. Yes, my name is Patrick, co-founder at Spritzle.io. We do a financial trading platform based on Ethereum technology. Our focus is on derivatives trading, specifically over-the-counter derivatives. And yeah, as I mentioned, we use Ethereum technology under the hood. So I'm assuming most of you are probably familiar with Ethereum. One big advantage is that on Ethereum, it's quite easy to do things that would otherwise be much more complicated to do with just Bitcoin and multi-sig alone. So for example, we allow users to collateralize funds on chain while contracts are open, while over-the-counter contracts are open. And I'll talk a little bit more about what that allows people to actually do. Quickly kind of an overview of the problem we're trying to address. So currently in the financial system, when two parties want to trade over-the-counter instruments or exchange-traded instruments such as equities, options, or swaps, for example, there's a series of intermediaries that you have to go through. And so what this does is it has an effect on the settlement time. So that typically there's a 3-day settlement time from when you enter into a trade until the trade settles. So this is known as T+3, or when you liquidate a position until you get your funds. So there's various different intermediaries involved. Typically there's a broker dealer that you have to go through, and there's also clearinghouses and custodians, such as the DTCC, for example, which keeps track of who owns which asset kind of electronically. So it's kind of a centralized system where you have a custodian who records who the owner is of a particular asset. But then you have also clearinghouses who move who help move the funds and act kind of as a trusted third party. And so the problem that we're trying to address is to kind of remove the need for as many intermediaries, so your trades can settle faster. So using our solution, it's much less expensive to settle a trade, and also we help manage counterparty risk. So today, when you trade on an exchange, you just trade with the exchange, and the exchange has reserves, so you don't have counterparty risk. So there's no risk that the other side won't hold the end of the bargain because you're trading with the exchange. The limitation with that is that you can only trade instruments that the exchange has listed. So if it's something that's not listed on an exchange, you have to trade on what's called over-the-counter. So when you trade over-the-counter, you have what's called counterparty risk. So you have the risk that the other party doesn't hold up the end of the bargain. So if you write an option, for example, or a swaps contract, and the contract ends, there's a risk that the other party will default on their obligation. And so what we allow traders to do is we allow traders to trade over-the-counter without going through an exchange or other intermediary, but limit the counterparty risk or eliminate the counterparty risk by allowing people to use the blockchain to collateralize the trade. And so we've seen examples of that in other projects as well. So for example, in the crowdfunding project that we looked at earlier, that's kind of an example of collateralizing funds on chain, where the funds are kind of held in escrow, if you will, until in that case the fund the project was fully funded. So here we kind of do some of the same, but we do it on Ethereum. And so you have a lot of flexibility in terms of what you can do, and this allows a lot of innovation to take place. So there's people who want to trade exotics, for example, exotic options, and so we allow people to do that. And so yeah, it's very accessible. The technology can be used globally. As I mentioned, there's no more T+3, so trades can settle in as quickly as 12 seconds. Whenever a new Ethereum block gets mined, your trades will settle, and the transactions that take place are fully atomic. So today, when you trade, typically you have, for example, a wire transfer that gets sent to a counterparty, and then a stock certificate that gets sent to the entity that sent the funds. And so it's kind of a two-step process, right? And so here, it all happens in one single step. So the funds get transferred and the security gets transferred in the same transaction. And so that whole transaction either fails or succeeds. So there's less risk of failure taking place. Also because there's fewer intermediaries that you have to go through. So, as most of you probably know now, some of the advantages of blockchain technology is that you can have you can have anonymity, or at least pseudo-anonymity, where you're trading just with your public key, and nobody really knows that it's you that's doing this, right? But at the same time, this helps bring transparency to the market. So this this helps reduce the systemic risks, for example, that are inherent in today's over-the-counter swaps market. As I mentioned, it's all ideally the whole trade takes place fully on chain. This is like when this kind of system is really optimal. So it's a little bit like the Apple ecosystem, where if everything is on chain, it works really, really well. It's very clean. So for example, if you issue an equity on chain and then write a derivative, so for example an option on this instrument that was issued on chain, you can easily collateralize using that instrument that's issued on chain. But when you're dealing with instruments that are issued off chain, we can do cash settled derivatives, for example. You can be anywhere in the world with internet access. So this is another advantage of this type of trading system. In today's market, you have to kind of, if you want to trade on an exchange, for example, you have to be kind of in the US or in a country that has access to US exchanges. So if you're not in a location where where you can easily access US exchanges, or if you don't have a US bank account, it could be quite difficult to move funds to a US exchange and trade on a US exchange. You typically have to go through a brokerage firm that works with the US exchange. And so here we kind of solve that problem. You don't really need to go through an intermediary such as a brokerage. You can trade directly on chain. You can either use the UI that we're building, or you can also trade using our API, or you can write directly to the blockchain if you're so inclined. A big kind of advantage for us is that Ethereum technology is maturing, and other blockchain technologies is maturing. We saw recently the white paper come out on sidechains, and as well as a prototype. So that's really encouraging news for this type of technology. So as blockchain technology evolves, we kind of help bring that to end users who want to use this for financial transactions. As Natalie spoke to earlier, we have compliance and regulation built into the platform. So for example, we KYC users who come on board and approve their public keys for transferring certain amounts of funds based on their KYC levels, for example. So a couple of things about the kind of products that we're working on. Again, you can collateralize on-chain. You can create new financial products that typically weren't possible before. So for example, you can trade with counterparties that normally you could not trade with. Because if you're trading over the counter, typically you have to trade with another bank, or at least a counterparty that you can sue in case they don't hold up the end of the bargain. So you have to know the counterparty. But here, you can create products where you don't know the counterparty because you can collateralize on chain. So just a couple of things that you can trade. You can trade options. You can specify your own. A lot of people ask for this. There are people. We have some customers that we're talking to who who want to write options, for example, on private equity, or people who want to write options that have custom strike or expiration dates. So some similar advantages with swaps. You can trade anywhere in the world. You get greater market transparency, which decreases the systemic risk that's typically inherent in swaps trading. We also have some customers that we're talking to who are interested in private equity trading. So, for example, you can do syndication very easily on chain. We have a kind of a prototype for a syndicate product where you can issue. You can create a private equity issue, which is an issue that represents a syndicate SPV, and so this is very similar to the crowdfunding example that we saw earlier, but it's geared more towards like an angel fund, for example, who wants to form a syndicate of investors who then all invest in a single startup's equity, for example, a single round. And so you can specify rules around, for example, expiration date. So if the whole issue doesn't get fully subscribed by a certain date, all the funds get returned to the investors. And so people are interested in this kind of functionality now because of the new Jobs Act crowdfunding rules that are being implemented. So, those rules allow a syndicate, for example, to take on more investors than what was previously allowed. So now when you have a lot of investors, you have to, there's increased overhead for the syndicate manager or for the fund manager, because there's more, there's more checks to collect, there's more payments to manage, and so there's oftentimes problems with people sending in checks or wire transfers, and then those payments getting reversed or not going through, because there's people, apparently there's still people who write physical checks that they put in the mail, and so these are all issues that the fund manager has to deal with, and so our technology kind of helps with this problem, because you can transfer the funds through the blockchain using an Ethereum subcurrency. Your transaction costs are very low, so you can bring in more investors. The clearing and settlement happens right away. Another use case is corporate bond issues. Again, there's regulatory restrictions around a lot of these things, but within, as long as you're operating within your regulatory framework, you can, for example, issue corporate debt to investors, and what you can do very easily, for example, you can issue coupon payments. So, for example, a typical corporation, let's say, pays quarterly coupons, right? But here you can pay more frequent coupons if you want. You can pay them every 24 hours if you wanted to, and you can have thousands of investors. If you have 100,000 investors, for example, let's say, right, you can have 100,000 coupon payments go out, every day. And, there's absolutely no extra cost to the issuer. It's all, it can all be handled through the blockchain. So one advantage of going through a technology like this is that it's market neutral. So existing corporate debt trading platforms, for example, have the problem of usually being controlled by a bank. And so when you're trading, you don't want to, as another bank, you don't want to give up your position to a competing bank. And so here you kind of have a system that's very market neutral, but at the same time allows you to collateralize on chain. So you don't actually need to have a kind of a bank in the middle that can kind of be a non-neutral party that you don't want to give away your positions to. And so we have API access to some of these things, so some of these products that we're working on, so for example the private equity and corporate debt products. So if you're interested in seeing a demo, I'll be more than happy to give you a demo afterwards. Yes?
How do you physically collateral, I can't say that word, on blockchain?
Essentially, there's a couple of different ways that it can happen. For one, you have kind of a subcurrency, and so, right, which is just a ledger that tracks, who owns, who has, which key has which balance, right? And so what you can do is you can have your contract hold some balance, right? So you can have, for example, when you enter into a swaps trade and you need to put in, let's say, 25% collateral, then what can happen is that collateral can go to your can go to the contract.
How does it do that?
Well, it's just assigned.
Physically, what's happening?
Well, so it's just basically in Ethereum you have just a ledger, and so you have public keys,
right.
And for each public key you have a number which represents how much money that public key holds. And then what you can do when you collateralize, you can you can have the public key of the contract.
Using the Ethereum currency.
Well, you can do it with Ether, yeah, but actually, like Ethereum allows this to happen natively, actually, if you want. But in our use case, we use a subcurrency, which is effectively the US dollar, so that you can trade in dollars. But yeah, with the subcurrency, it's kind of like up to us how we implement it. But you can typically just assign a balance to a public key, and that public key can be the key of a contract, and then that contract can spend that balance. Yes.
Or you're asking like the on-ramp for taking your dollars out of your pocket and getting them into the system.
Yeah. Basically, listen.
Sure.
At the end of the day, it has to be something of value that I put down as collateral. It just can't be, ones and alphanumeric kind of string sitting out, in a database somewhere.
Yes.
Or not, right? If I enter into a swap with you, I want to know where your money is.
Right, of course.
Right.
counterparty risk, right? How you
Yeah.
Right.
how you manage your
Sure.
counterparty
And I mean,
risk.
that's why, I mean, beauty or not, the beauty of the bank today is I know where that money's at, I know where
Sure.
to get it.
Yeah, so I mean, so the way we kind of deal with that is we use what's called, we have a currency administrator, which is a separate legal entity, and it's kind of similar to the Tether model. If you guys are familiar with Tether, it's basically an administrator, which is an entity that holds the fiat currency and always exchanges it 1-to-1 for the Ethereum subcurrency. So the Ethereum subcurrency is quasi-cash. It's always 1-to-1 exchangeable for US dollars.
So there's a third party out there that's really holding it.
Well, I mean, you could think of it that way. I mean, but you can also think of it like, the US dollar when it was on the gold standard, right? Like the real money is the gold, the treasury, but nobody ever goes, and exchanges, right? Like, you just trade those dollars, right? So you can do that here as well.
There's no gold standard.
But what you're saying is you gotta pre-fund those positions through into this third party.
Yes.
So that
That
you
was my
eliminate the
question,
counterparty
exactly.
risk. So yeah.
But yes.
That's it, you have to pre-fund it into this third party.
Yeah, so you basically buy the cryptocurrency, right? You buy
Right.
just like you buy Bitcoin, you buy the cryptocurrency.
Right.
But unlike Bitcoin, for example, it's pegged to the US dollar, so there's no volatility. Well, there's, you have the same volatility as the US dollar, basically.
Right.
Yes.
Two questions maybe packed into
So-
one. Where are you guys in terms of the development process, and which specific securities are you guys gonna roll first?
So, I mean, where we are right now is we have, kind of a minimum viable product. So, we had some customer demos, and, we have something that we can go live with, pretty soon. So initially it's going to be kind of like custom. It's not going to be something that's totally open to the public, but, something that's specifically built for a particular customer's needs, for example. So if they're, for example, a private equity fund or an angel fund, and they want to issue, shares of, to their syndicate holders, for example, that could be an initial use case. Another use case that we're targeting is options. A lot of customers want to trade options over the counter and limit counterparty risk.
So when you say pretty soon, is that like a 3-month pretty soon, 6 months?
Yeah, Q4.
So there's still counterparty risk though with the third party or whoever it is that's really holding the collateral, right?
Yeah, so that's true. The administrator, the administrator himself bears a lot of risk.
There's a ton of risk. I mean, it's not Goldman Sachs, right? I mean, it's some, I don't know, right? Somebody nobody knows about.
Well, somebody could write, some co-insurance on it, or they could go to like a State Street or a bank.
Yeah,
My only point
it can be a trust company.
You know,
that's
my
right,
point
yeah.
is you're saying no counterparty risk in your slides. Well, something like that. You're alluding to it, and I'm saying.
Right, I mean,
dude, I see a ton of it.
Well, the counterparty risk is typically between the two traders, right? I mean, you have the.
The risk
I mean,
that I can't get my collateral is huge.
But you have that risk also when you're going through the current system, right? I mean, if you're going through a clearinghouse or through other intermediaries, I mean,
You
those
do, what I'm saying
parties
is
that
those
need-
guys are known established players,
Sure.
which reduces that risk.
Sure, but I mean, here you can trade instruments that you previously couldn't trade before, right? So you only have to now trust this one entity, which is the currency administrator, whereas previously you had to trust the counterparty. So if you have 1,000 counterparties, now you have to trust 1,000 entities, which could be even lesser known or lesser trusted entities than this currency administrator.
Have you guys approached like a State Street or a Bank of New York Mellon in terms of having them be the custodian for those assets?
That's kind of the plan, right? So we're kind of working on that, right? We're working on a lot of different things, but yeah, that's definitely something that's on the roadmap for us. Like ideally, we don't want to have anything to do with the currency administration whatsoever. Ideally, that should be handled by a bank or some other payment provider. And we can do that on a kind of case-by-case basis. So, it can be a trust company that's, only dealing with, a few select counterparties, or it can be a bank, or it can be an established payment processor like a PayPal, for example, or something like that, right? So yeah, absolutely. I mean, that's definitely, it kind of depends on what the customer needs are.
Also, this third party can be avoided if you transact in the native currency of Ethereum, which is Ether. We just feel that for a wider adoption, people would not be willing to subject themselves to the unknown volatility of that native currency. So that's why we've got this US dollar pegged alternative for people.
Sure.
Questions? So yeah, quick demo, just a minute and a half. So this is kind of our prototype. We have a much more elaborate UI build that I can kind of show offline if anyone's interested. But yeah, this is just kind of a prototype. So what you see here is that you have a trader who created a swaps contract for 10 barrels of Brent crude oil. And so we can see here that now the contract is deployed to the blockchain, and the terms of the contract are kind of programmed in. So once the contract has been deployed, it's immutable, and you can't change the terms of the contract. And so what's specified here is that the contract demands 25% margin in order to take a side. So in this case, you'll have this trader Bob who takes the sell side of the contract. And we can see here that he's required to pay $162 in margin to enter into the contract because it's for 10 barrels at $66.99 a barrel. So once he does that, the funds will get deducted from his balance, which is in the top right there. And we can see now total collateral, that's the amount of money that's held in the contract itself. So these funds are now on chain and can't be redeemed until the contract ends, and then the contract decides who gets how much. But Bob can't take that money back out, basically. Now we have Alice, who's taking the other side of the trade. So she's taking the long side of the trade. And she can see here that the other side has already been taken by Bob, so she can see who the counterparty is here. Of course, this could be a pseudonym, right? Or maybe we don't have to show the name at all if that person wants to be anonymous. And again, she can see that, okay, this is how much collateral is already in the contract, and this is how much collateral she has to put in order to take the other side. And so once she takes the other side, the contract will be kind of fully collateralized, and then both parties kind of have to wait until the contract expires in order to get their payout. And you can kind of see here the mark-to-market P&L as the contract kind of runs. But you'll see in a few seconds, I mean, we've created a very short expiration time here. Typically these contracts would have longer expiration times, but you have that flexibility. So now on this screen, the contract has settled, and you can kind of see here, the P&L is actually going to change one more time because there's another block that gets mined, so it kind of like updates block by block. But yeah, so you can kind of see here what the current P&L is for each position. And so based on that, that's what's going to happen with that collateral. So for Bob, he's going to get $5 less than what he put in, and Alice is going to get that extra $5.
So,
It's actually going to update, yes. It's actually third. So when it finally settled, it was minus 1362 for Bob and plus 1362 for Alice, which came out of that 300 some odd dollars of collateral that was in the contract. Yes.
did you ever consider doing it live with live pricing? Because like most derivatives are two-party agreements, so that if the price of one goes up, the other goes down.
Mm.
Just thinking about the hourglass wallet that you, or the stream what we just did, that you like have like a collateral pool that commits to it automatically, so so that you eliminate counterparty risk basically.
So I didn't fully understand the model. So you.
So basically, if you take an option,
Yeah.
one party buys it, the other one sells it.
Yeah.
And during the lifetime of the option, the price changes.
Mm-hmm.
So that can be offset directly to your wallet. So basically,
Oh yeah.
that eliminates completely any collateral requirements or counterparty risk.
Yeah, absolutely. But I mean, I guess the issue is that the person can withdraw the money from the wallet, right, while the contract is open.
Well, but you, in the previous presentation,
Yeah.
with the you can fix that in the blockchain. So you can.
Oh, I see. So kind of like with the payment channels model.
It could be, yeah, if there's no more funds, that it's an auto executable and it says, okay, that's it, contract can't see it.
Right, yeah, of course, yeah. Yeah, we can do, I mean, that's actually quite easy on Ethereum. So you don't even need this kind of like payment channel or multi-sig approach. Like on Ethereum, you can actually just have administratively funds withdrawn, from, just like you have, when you have a margin account with your brokerage firm,
Yeah.
they can kind of administratively debit that account, like as the value of your position fluctuates. And so yeah, we can totally do that. I mean, in our newer version, it kind of works, more like that. So yeah, absolutely. Especially like when it comes to like things like coupon payments, it works really well because if the issue just has a cash account where they have the money, right? And then when they want to make a coupon payment or when a coupon payment is due to all the shareholders, it just comes out of that account. And so if there's no money in that account, then the coupon payment doesn't get made. But that's almost like a better use case for that model because it just gets administratively debited. Yes, another question.
Trades per second on Ethereum, what are you guys thinking?
I mean, it's unclear, right, because they haven't fully launched yet, and there's a public POC network. Like if there's no like real other traffic, other significant traffic, maybe like 5 to 10 of these types of trains, like kind of based on like these use like 20 to 50,000 gas, and you have a 3.1 million gas limit per block.
One other question, are you guys consider white labeling this so that people, rather than having, so banks can basically buy it and utilize it as their own platform?
Yeah, absolutely. I mean, I actually think that that's kind of the initial go-to-market. I mean, we've been approached by some customers who are actually interested in white labeling the platform. Like they have their own kind of platform and UI and like network that they want to build. They just want to use this for a clearing and settlement, right? And so that's actually an optimal use case. Yeah.
Awesome.
Yeah. So I have like I mentioned, I have a more elaborate demo. So if anyone's interested, I'd be happy to share that.
That's it for cohort 3. See you demo night for cohort 4.